Europe's growth rate in particular for this year.
Okay, and again, based on the war and the rising energy prices, etc. from that.
Correct. And if ever we were to have sanctions on gas exports from Russia to Europe, then the revisions would go into negative, into a recession for Europe.
Okay, let's go back a little bit to before the war in the Ukraine. You were saying that there was already a slowing impulse then, based presumably on the monetary authorities beginning to row back from money printing, beginning to row back from the huge levels of stimulus during COVID, and that was already giving us some kind of slowing impulse throughout the global economy, or is there something else in it?
Well, there were several factors. So if we start in China, it was trying to continue with the zero COVID policy in the face of Omicron, a much more infectious variant of COVID. It is almost impossible to run a zero COVID policy without disrupting the real economy when you have Omicron around. And already China was slowing and was causing a renewed round of supply side disruptions, which were impacting Europe and the US. So in China, it wasn't about monetary policy. It was about the COVID policy that was pursued. Unlike the West, that is trying to live with COVID, China is trying to still eradicate completely COVID. That's a significant difference in strategy.
But it's impossible for that not to have an impact globally, and impossible for that not to have an impact on inflation if that supply chain disruption is going to continue. And it looks like it's going to continue possibly it's hard to see how it ends now with Shanghai being locked down on and off all the time and Beijing beginning to be concerned about rolling lockdowns there. It's hard to see how the global supply chain ever gets back to normal.
That's correct. And that was actually clear almost a year ago. I remember at the time, a few of us were warning against this notion that the cost push inflation would be transitory. If you talk to the companies involved, most of them did not feel this was going to be transitory. Felt that it would be prolonged. It would last for most of the year and into 2022. Now, the renewed China disruptions mean that we will have supply disruptions for most of this year as well. So yes, absolutely. The supply side is not going to heal as quickly as we all like it to heal.
Yeah, I saw a number this morning that made me think, people talk at the moment about inflation peaking and how when near peak inflation it's going to turn around, the Fed will be saved, etc. But the price of farm inputs in the UK has gone up 23% in the last 6 months alone. Now, a lot of that is fuel, but also in there you've got feed and fertilizer, etc. With those kind of numbers, it's impossible to look at that and go, yeah, okay, inflation's probably peaked.
That's absolutely right. And the same with wages. Now, it's important to distinguish which inflation are we talking about. In the US, headline inflation at 8.5%, has that peaked? Maybe. It could well have peaked. But if we get another disruption, that will be reversed quite quickly. But if you look at the core measures, which are influenced less by energy in particular, if you look at the core measures, that has not peaked. So we should expect inflationary pressures to persist. Now, there's a camp. It used to be the transitory camp. Now it's called the immaculate disinflation camp that believes that somehow inflation is going to come down very rapidly, not just because of base effects, which will be in play, but because we will see all these inflationary pressures just disappear. It is highly unlikely. And keep an eye on the labor market, because so far wages have been lagging inflation in a serious way, but there are signs that wage growth is picking up, especially as people change jobs, which they're doing much more frequently now.
And what are these signs? When you say there are signs, you mean just that you can see in the data that when people lose jobs, I've seen this data, they're getting fairly impressive uplifts, 10, 20, 30, 40% on shifting jobs. But you're not necessarily seeing the rises come through for people who remain in steady employment with the same employer.
Correct. So the first round is those who change jobs. And there's been a recent survey done of over 2,000 US residents who changed jobs. And about 30% of them gained 6 to 10% increases in their wages. Another 25% saw 11 to 25% gains. Over 10% saw 26 to 50% gains, and it goes on. So round one is job hopping, if you like. But if you're an employer and you're hiring people at a higher entry wage, it's only a matter of time when you have to adjust everybody else's wages.
Yeah, it's interesting, isn't it? When we've been looking at Money Week, we look what happened in the 70s, etc., and everyone just slightly behaves in this when they look back at the 70s as it was unionization that drove wage increases. The unions were the first point, but actually, of course, the unions still existed in the 1960s, and you didn't see this huge wage inflation then. So it is entirely possible that it's inflation that drives unionization, which drives wage rises rather than the other way around. So we may just be at the beginning of this cycle.
We could. I mean, the one big difference with the 70s, and I think it's why we're not going to see the sort of spiral we saw then. We'll see one, but much smaller in magnitude than what we saw then, is you don't have indexation. That was a turbocharger in the 70s. We don't have that today, but we will see a cascading of wage increases throughout the labor force.
Okay, because we have an unpleasant dynamic now where real wages are falling, and of course that's an obvious recession sign. But there's a chance that real wages will at least catch up.
Oh, absolutely. I mean, remember that there are three distinct phases in the wage adjustment process. The one is they fall behind because inflation surprises them. It is unanticipated. Second, they look to compensate for past inflation. And then third, in addition to compensating for past inflation, they look to compensate for future inflation. You get anticipatory demands. That happens when inflation remains high and when inflationary expectations are de-anchored. So that's why it's really important that central banks try to catch up with developments on the ground. The Fed in particular is very late.
Well, this is the problem, isn't it? They spent a very long time last year saying this is transitory, it's going to go away, therefore we don't have to do anything about it. And obviously the markets have been way ahead of the Fed, and now we're at the point where the Fed has A, lost credibility, and B, has got so much catching up to do that if they try and do that catching up, they will definitely cause a hard landing.
That's absolutely right. I'll give you two things that really caught my attention. It's not that it took till the end of November for Chairman Powell to, quote, retire, unquote, transitory from his vocabulary. He should have done that way earlier, and he should have started adjusting policies before. But the week in March, the week in which we printed a 7.9% inflation rate, the Fed was still injecting liquidity.